Good evening and welcome to this edition of Capital Markets live on Channels Television, where the market speaks and we analyze and also tell you what that means for your investments. I am Will Ebong. Before we jump into the domestic equities market and the eventful inflows we saw in macros, let's check in with the global market space and see how they performed on Friday. European stocks, to begin with that, moved broadly high on Friday, but edged just above the flat line at the close of the bell, with next week's Fed Reserve policy decision in focus in the United States. Now, DAX closed higher at 24,028 points. We also see the FTSE 100 in the UK up down 0.45% to close at 9,667 points, and the CAC 40 in France also down 0.09%, close at 8,114 points. And they are also awaiting the outcome of the Federal Reserve's Open Market Committee meeting next week. Expectations of 0.25% rate cut is surged in the past 2 weeks. So with money markets now pricing in an 87.1% chance of policymakers trimming their key interest rates. And let's look at Asia markets. See how they traded on Friday. It was mixed following a subdued Wall Street session. Japan's Nikkei 225, you see that dropping 1.05%, coming down from that 51,000 level we saw this week. Now, Shanghai, as in mainland China, up 0.7%. Hang Seng Index, also in China, up 0.58%, close at 26,085 points. Now, the Monetary Policy Committee in China also delivered a unanimous cut, citing weakness in some key economic indicators, even as headline inflation has hit significantly and is expected to be revised lower in the first quarter of 2025. Now let's look at the U.S. and see how they performed. The NASDAQ Composite edged higher on Friday, I must say, securing its fourth straight winning day as traders digested inflation data that could provide further incentive for the Federal Reserve to lower interest rates next week. Let's see the Dow Jones up 0.2%, NASDAQ also up 0.3%, and to settle at 23,578 points, and the S&P 500 up 0.19% to finish at the close of the bell. Let's see how domestic equities market performed. You see the NASD Securities Exchange closed the week lower as the index dropped by 5.46%. See 3,401 points, market cap at 2.04 trillion naira. Trading activity, we see it was mostly positive. Volume jumped 428.47% to 28.72 million units traded. Value was also up 447 points there to 754.8 million naira. And deals, that was the negative there. We see down 12.9%, 108 deals for the week. On price performance, industrial and general insurance PLC, that's IGI, gained 0.5%, added 17.78% to close at 53 kobo. And we see other stocks there. Air Liquide PLC gained 10%, closing up at 11 naira, 99 kobo. Central Securities Clearing System also closed up 6.13%, closed at 39 naira, 80 kobo. And we see the losers, we led by Food Concepts PLC, which fell 18.81% to close at 3 naira, 15 kobo. Now, on the activity chart, we see the most traded securities for the week were Central Securities Clearing System, CSCS, and we see the Friesland Campina, Wamco Nigeria, and Okiti Pupa All Palm featuring on that list there. Now, let's look at the NGX, how they performed. And we see them closing the week on a positive note. The all-share index rose by 2.45%, closed at 147,000 points. Market cap, we saw that regaining. It started the week on a shaky note, but we saw them recoup. Market cap rose 2.67%, closing at 93.722 trillion naira. I'm not taking us back now. Now, in terms of activity, investors exchanged about 6.61 billion units of shares. That's a green close for that volume. Also, the market value, we see that closing in the green, it was up 113.22 billion naira, and all transacted at 109,590 deals. Sectoral performance, let's see, mostly positive. Banking index added 3.2%, consumer goods up 1.56%. Now, we see industrial goods, the outlier in terms of positive trading, 7.38%, insurance 1.48%, and oil and gas, I could say that that's the outlier here because they're the negative. But I would highlight industrial goods, which was really up because of Dangote cement. Oil and gas down 0.57%. And the losers, the top gainers for the week, we see NCL, Nigeria PLC, closing at 72 naira 70 kobo. They were up 33.03%. Now we see also UACN, 22.69%. Massive jump for that stock there this week. And also Guinness Nigeria PLC also up 18.56%. Now, meanwhile, we see E-Transact, they were on the loser side. The losers chart, we had the heaviest declines from Alti Briscoe, that was down 12.79% to close at 3 naira. We see Legend Internet also down 10.71% to close at 5 naira, and Union Dye Consult was also down 10%, close at 6 naira 30 kobo. Meanwhile, E-Transact, International PLC, Cornerstone, and Access Holdings, they were the most traded stocks in terms of volume and value. So that's very much interesting there for investors. A lot of cherry picking and bargain hunting that took place on the Nigerian exchange this week. Now, Nigeria's economy, we saw this week, posted a modest rise in the third quarter of 2025, with GDP growing by 3.98% year-on-year. And the latest figures from the National Bureau of Statistics showed a slight improvement from the 3.86% we recorded a year earlier. And the oil sector contributed 3.44% to real GDP in the third quarter, but this was down from the 4.05% we recorded in the second quarter. But while the non-oil economy made up 96.56% of what was recorded in the third quarter. And across the non-oil sector, we saw agriculture accounting for 31.21% of growth, industries 15.7%, services 53.02%. Services remain dominant with that uptick. Let's look at what we have for this week as well. We see a lot of borrowing still happening in the Nigerian economy. Nigeria's debt management office has raised about 709.6 billion naira at its latest treasury bills auction, with investors seated heavily favoring the 364-day paper, and the shorter 91 and 182-day bills were undersubscribed. The one-year bill drew strong demand, with subscriptions of nearly 700 billion against an offer of 450 billion naira, and that's leading the DMO to a lot, about 636.5 billion naira, almost 90% of total proceeds. Now, the 364-day stop rate climbed to 17.5%. Now, that's up from 16.04% we saw at the last auction. Rates on the shorter tenors were held steady at 15.3% and 15.5% each. But I had a lot of macros coming this week. GDP, we saw PMI, a lot of things going on, and Nigeria's economy seems to be, picking up momentum here. Business activity seems to be thriving, and what's behind all that? Caleb Alimi, Chief Dealer, Providence Bank, is joining us this evening to unpack that. Good to have you join us on the show.
Thank you for having me here.
Caleb, it's good to have you live here for the first time. I must celebrate this. So let's just celebrate it, because it is one, and I hope we'll have more of you coming to the studio live to talk about what's happening in Nigeria. It's good to. Thank you so much for coming in.
Thank you for having me. It's lovely to be here.
Yes. Well, let's kick off with one of the burning issues that, it has been lingering. I would say lingering issues in Nigeria that has to do with the capital gains tax. How much of what we've seen in the NGX, the performance in the capital market, can we lay at the doorstep of the capital gains tax? Or should we put it at the FX or other macros that are coming into the reports we've been seeing?
Oh, well, so capital gains tax has been a big topic in the capital markets, and it's because of the sudden jump from 10% to 30%. Initially, when the news broke and when it began to look like a reality, we did see a panic in the market, and we saw the market actually tank across all of the sectors, and that was not uncommon. We saw a lot of institutional investors, banking their profits early, and that the market has done very well, all through the year. So it was just the right time for some of them to bank that profit, and so we saw a lot of that happen. We also saw, a bit of a sell-off from the foreign investors, but largely it was the locals that did most of the selling, as a lot of people just wanted to protect their, capital gains so far from the tax that could come off.
Okay, so you're talking about the locals that were selling off. The tax exempts small investors. Let's just say small investors under 150 million. Is that enough to keep the market stable, or should we depend on the more bigger players in the market if they pull out as a result of this, what do we expect to happen in the market?
So we need to look at the institutional investors, the pension fund administrators, the asset managers, the guys with the deep pockets, not necessarily the retail investors. Those are the ones that are looking to bank their profits. They're being assessed, on how much returns you've generated. And then if you know tax is going to take 30% of that, then you want to cash out as quickly as possible. And that's what we've seen. So for the retail guys that are trading under 150 million, they're sort of covered. But the institutional guys, the foreign portfolio investors who find our stocks rather cheap because of the exchange rate, they would expect to protect themselves by taking their profits really early. And that's exactly what we saw when that announcement broke. And then you saw that the Minister of Finance, the coordinating minister, came out to say, look, it may not necessarily be implemented. And then there's a proposal to reduce it to 25%. And then we've seen the market, sort of pick up after all of those announcements. You could also argue that the prices had sort of bottomed out, and so it was time again for, bargain hunters to begin to come into the market.
Okay, I know that you're more of a fixed income FX expert here, not an equities expert, but this concerns the capital market and definitely it filters in. So if we see this movement we had from the fixed equities markets, the performance, almost more than 6% drop we saw at the equities market,
correct.
How much of it filtered into the fixed income space?
It will be, we can't say exactly that there's a direct correlation between that sell-off and what we did see or what we've seen in the fixed income market. But we would say, yes, there was more liquidity in the fixed income market, which, afforded the debt management office to sort of raise more money, during the time that panic existed. For example, like the auction 2 weeks ago, the DMO raised over ₦1 trillion, from the market, and you could attribute some of that to part of the inflows that came from the capital market. Is there a direct link? We can't exactly say, but we can say that the market was more liquid and there was more interest in fixed income instruments. Okay,
what asset classes would you say probably maybe benefited or saw a kind of like uptick in terms of liquidity, as the movement in monies? Where did we say we can say money's moved from here to here? What asset classes?
The easiest answer to that would be the money markets, because when they sell off those stocks and they are, awash with cash, you want your cash to earn something. So you move to the banks, and then you move to fixed deposits. You move to other mutual funds. You move to treasury bills and other fixed income instruments generally. So we could say that some of those monies flowed into those markets temporarily, and then when you saw that the prices had sort of bottomed out and they began the uptick, and then they came back in straight up.
Okay, let's just talk about it. Right, there's something in the news. The NGX is seeking a deferral of the implementation of the capital gains tax. It's asking the government to possibly give a 5-year moratorium right now, because if implemented, they feel that would disrupt activities in the equities market, the gains the equities market have already seen. So with pressure from all these groups now, do you see the CGT being reduced from say 30 to 25%, or suspended, or even scrapped before January 2026?
I think the best case scenario would be the scrapping. And then other scenarios, the best case scenario for all investors would be the scrapping, and then other scenarios would be a reduction and all of that. I do agree with analysts that think it could set back the gains we've seen in the capital market. It's probably a bit too premature to focus all of our gains on that sector just yet. The reforms that this administration has brought into place has sort of stabilized the economy. We've seen the exchange rate strengthen almost 10% over the last 1 year. And you've seen a lot of stability in FX, right? I've been in the market for a while. You've not seen this sort of stability that we've experienced over the last 2 years. And then the market is stable. You can predict, you can plan, businesses can plan. And then disrupting all of that, through this type of reform that affects investors. You can see the capital market is growing in leaps and bounds and all of that. More companies are listing, and more players are coming in, more people are getting educated about it. There's just a lot of gray area around, the capital gains tax. It could actually slow down, that deployment of capital to that market and eventually to the businesses that need to scale. Okay,
speaking long term, 2026, what do you see this capital gains tax doing if it is sustained and maybe implemented?
The market is resilient, but there will be some sort of slowdown initially. And then there'll be time to understand the ways you can maximize your returns given the given the circumstances, and then markets will then pick up again. But definitely there'll be a setback, or there'll be a sort of like slowdown in the traction that markets is gaining.
Definitely. Let's keep that thought. We'll go on a quick break now. When capital market returns, we'll be talking more about how this investment affects your pocket. Stay tuned. Welcome back. If you're just joining us, you're watching Capital Market Live on Channels Television, and we still have Caleb Alimi, Chief Dealer, Providence Bank, still with us in the studio discussing how investments this week performed and what it means for future investments and possibly where you need to move your monies to. But this week we also saw the FEC, that's the Federal Executive Council, approving a tentative budget for 2026. That's the medium-term executive framework, for 2026. And we saw some of those frameworks that were the assumptions that were made. If we look at that very quickly, we see on the screen there, that's the 2026 Federal Reserve projection. We saw that's total revenues coming in from all ministries, from all federal agencies at 34.33, but the ballpark figure is between 50 to 54 trillion naira. All price benchmark for 2026 is pegged at priced at $64.85 a barrel. We see exchange rate assumption for 2026 at 1,512 naira to a dollar, and all production benchmark is at between 1.8 to 1.84 million barrels per day, and despite the target of 2.06% that was made. And we saw fiscal deficit estimate for 2026 also at 20.1 trillion. And Caleb, with all that is happening here right now with the government, this projection that they have for 2026, 50 to 54 trillion naira for budget, and 20.1 trillion naira deficit. That's a huge one for budget and the deficit. What does this speak about Nigeria's fiscal space right now?
I mean, it's the government, this current administration is focused on growing the economy. And to grow the economy, you have to spend. To grow the economy as well, you have to, be organized. You have to be safe. You have to be secured. So I guess a lot of that should be going into some form of security, expenditure, and all of that. So 20 trillion deficit is interesting because that's a jump from 2024, 2025 deficit. 2025 deficit was 13 trillion initially, but then also this budget is a very ambitious one, moves from I think 33 trillion to 54 trillion, and so it's just natural that the deficit grows to 20 trillion, but it's just still 3.6% of GDP, so it's still allowable.
Okay, so where does this leave a room for, say, new infrastructure or growth projects that probably are tied to the fixed income investments? If debt servicing and the deficit is taking most of the budget, a huge chunk of the budget, where does it leave for infrastructure investments?
Yeah, well, I think part of the things we're going to see when the full breakdown of the budget comes out is the target areas that the government really wants to spend on. And the idea of the deficit is that, they're making just 34 trillion, and they need to spend 54 trillion. So the balance 20 trillion has to come from somewhere. Yes, debt servicing is part of that, but there's also going to be fresh debt, to also create that, buffer for the spending, right? The estimate for oil production is 1.8 million barrels per day. That is another tall order. We're currently at 1.36 million barrels per day. That's saying adding another roughly 500,000 barrels per day. That is, quite ambitious given all of the things that are happening. So imagine that there is a shortfall and they don't meet that target. All of that will still fall under the deficit. So where there's a revenue shortfall and then you still need to spend, given that you need to focus on the economy and grow the economy, then you have to borrow that from, the capital market and the fixed income market. Now, for us as fixed income traders or for us as fixed income analysts, what we're looking at is the size of the deficit, because we know that money comes largely from the fixed income market, And for example, this year we've seen the government raise roughly 23 trillion from the fixed income market in forms of local debts, FGN bonds, in form of Nigerian treasury bills, in form of Euro bonds, and in form of Sukuk bonds. All of those put together, about 23 trillion. And we understand at the beginning that the deficit was supposed to be just 13 trillion. But you know, as you go, things happen. You know, there's need to spend here, there's need to improve certain spending, there's need to, so different things come up, and the government needs to, you know, create money to solve all those problems and meet those demands. And that's why we expect the deficit of 20 trillion, probably even expand further than 20 trillion.
Speaking of debt, Nigerians, we saw a recent report stating our total debt stock rising about over 2%, and we're currently about 152.39 trillion naira. That's for the second quarter of this year. We've not even gotten the third quarter report yet. So with this ballooning debt that we're getting and the projected debt that we are going into 2026, we're not even done with 2025. What does our fiscal debt sustainability, how do you see it? Is it on shaky ground?
Well, even the biggest economies borrow heavily. Like the biggest economies, like the American economies, you know, also highly geared, if that's the word some of us use. I think the story will be what percentage of GDP is it? How big does it consume our GDP? For example, currently in Nigeria, just 3.6% of GDP. That is still allowable when compared to other economies. What are the big economies doing? You know, are they under 5%? Are they under 10% and all of that? So until it totally maybe consumes our productivity before we begin to worry. Yes, the numbers, you know, in isolation look really large, but when compared to our GDP, they don't look so big after all. Okay,
but if we continue to see this debt, especially sustained borrowing within the domestic market, are we going to see yields continue to rise? And if so, are they going to crowd out the private sector? There's private credit to the private sector, because if yields or interest rates are high, that makes borrowing costs higher for businesses, small businesses, the real sector in the economy.
Absolutely, you're correct. And speaking about that, you know, we could even take a cue from the recent NTB auction. The last auction in November closed at 16.04% for the one-year paper, but the auction this week, you know, closed at 17.5% for the one-year paper. That's about 150 basis point jump, you know, just because the government needs to borrow, right? So will we see a crowding out? Possibly. However, we've seen that, you know, private sector guys have found a way to borrow, you know, outside the banks. They float commercial papers, they float their own corporate bonds, and they're able to get rates that are largely reasonable. Another thing that we've seen is the MPR, right? The government, the central bank, has sort of shaved it up by 50 basis points, from 27.5 to 27. But what we did see was actually a technical cut. By adjusting the asymmetric corridor, they effectively brought down, you know, borrowing rates and lending rates among the banks. And then that would definitely impact on the guys that take credits as well. So we expect that the CBN, while going into next year, we expect, you know, inflation, the base effect has bottomed out. Inflation could remain in double digits. We don't expect to see big cuts, you know, or jumbo cuts as one president will call it. We don't expect to see that in the NPR, but what we'll continue to see is an adjustment of that asymmetric corridor to allow credit transmission into the real sector. So yeah, companies will, you know, continue to sort of borrow cheaply. However, if I can get, you know, yield of up to 21%, 22%, 23% from risk-free, because the government is seen as risk-free, then the corporate guys will expect to pay much more than that. So will there be a crowding out effect? To an extent. But what I often say is the market is big enough and can accommodate all of those demands.
Okay, with potential or possible rise in yields because of, you know, demand for, I mean, the supply and then possibly demand from investors. Yeah. Would we see this appetite from the government borrowing? Would we see it, say, affect the stock market, say, in 2026? Maybe investment in the stock market, because if the yields keep going up in the fixed income market, what does that hold for the Nigerian equities market?
It depends on how high the yields go. I mean, the capital market has done how many percent this year? I'm sure more than 30%, more than 40%, right?
That's the equities market, yes.
Right, has done more than 40%. So, but it all depends on the investors' risk appetite. Some investors are comfortable with 20%. Some investors are looking for something more, and then you find them in the capital market to make the 40%. So it depends on the investor's appetite. It depends on how the portfolio and the resources, the control are allocated. You find that largely in Nigeria, most people allocate, you know, to fixed income, to risk-free, down to the risk sector. You could just look at the asset allocation of pension fund administrators, for example. About 75% of it is in fixed income instruments. And then the balance is a mix of equities, real estate and other, private equity and risky stuff. So you find that most people will move to fixed income largely, and then the few guys that still have that risk appetite will go into the equities market. But if we look at the biggest investor currently in Nigeria, which is the pension fund administrators, most of the portfolio is in fixed income. So the higher the yields there, the better for them.
Okay, so I know that the central bank governor did make a statement when he explained why they held interest rates at 27%, said the growth or the easing we're seeing is kind of like still on shaky ground. Even the growth we're seeing in the economy, they just want to be cautious. So if the CBN governor is taking a cautious stand now, how do you see foreign investors? What does it signal to foreign investors? Are they going to also show caution in bringing in their monies?
No, I don't expect the foreign investors to show caution in bringing in the monies, and for a few reasons. One, interest rate is still largely high here compared to where they're coming from. The US Fed FOMC is meeting sometime next week, where the market has priced in a 25 basis point cut. That is another cut. So these guys are yield hunters. Our yields are still double digits, and then our currency is still relatively cheap to them, so they would always come for the yield. So, and you find that even when the central bank continues to issue OMO, it issues OMO around the yield significantly higher than inflation rates. Inflation rates are about 16%, and then the central bank yield is around 22.5%, on their OMO paper. So that gives them, plenty of room, and is an incentive for the foreign portfolio investors to continue to stay. I don't see them, leaving anytime soon. If we compare year on year where the exchange rate was, this time last year it was around 1500 levels, 1580 or thereabouts. And right now, 1 year after, we're at around 1452. That's almost a 10% gain. And the reserves have grown about $5 billion in that same space. So the foreign investors, I'm definitely sure, are looking to Nigeria to say, hey, we're coming.
Now, we've seen that revision from the CBN about the cash withdrawal limit. And now we know also the results from we see the reports about currency outside the bank and circulation ticking up for the month of September. So where do we stand now in terms of inflation and managing liquidity in the system?
The central bank, must be given some credit. I think they've done a lot of work, and they've done some good work in, bringing inflation down. Obviously, the base effect, has, kicked in, but then we've seen that it has also consistently dropped. They're right to be cautious. At this point, I can't even question any of their moves, because many of their moves, many of their policies have yielded tangible results. So, we just have to continue to trust them to be cautious and to gradually, they've said their focus is exchange rate stability, and low inflation. And I think they're achieving that. The exchange rate has been stable for the last, 6 months or thereabouts. Inflation has been coming down, and they expect that it could taper off. Going into next year, base effect has gone out, and then we're entering a pre-election year, and we know what happens pre-election years. So they're cautious, and it is rightly so. Exactly. We expect that when the spendings begin, there could be, some sort of inflationary pressures, but they continue to deploy their tools. Open market operation bills is one of their tools, and there are other, tools that they deploy to just ensure that liquidity is tightened and that money supply will be controlled. I have a good confidence in this central bank administration. I think they'll continue to do a good job.
Definitely, we'll keep watching and see how the CBN tames inflation and keeps it under control. And that's a wrap on this edition. But before we go, I just want to say, Caleb Alimi, thank you so much for joining us. Caleb Alimi, Chief Dealer, Providence Bank, for joining us Capital Markets. We hope to see you next time and have more conversations on the program. Always remember, whether the markets are bullish or bearish, knowledge is always your best investment. Keep watching, keep learning, and keep growing your financial savvy. You can catch this again on our YouTube channel. I'm Will Ibang. Thanks for watching, and I'll see you next week.